Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover some key topics and risks for investors tied to developments around the world. And here's the best part, we take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time by entering it in the chat, and we'll get to those questions in just a few minutes after we share some of our latest insights. Now, we've got a lot to cover, but first we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we talk generally about the markets, the sectors, and the areas of investing we think are likely to perform well or poorly, and why. And things can and do change, so the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary here on the Global Strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As always, I'll be watching the chat and our questions closely, and we will get to those in just a little bit. For now, Jeff, go ahead and kick us off with a rundown of what we're watching this week that can move the markets.
You bet. So today we got the latest readings on how the world's biggest economies are faring as the first quarter winds down and tariffs loom large, with the preliminary March Purchasing Managers Indexes for the US, Japan, India, the UK, Germany, France, and the Eurozone. Now, the Eurozone PMI survey for March provides us a sense of the hit to activity from the rise in uncertainty created by US tariff threats. The PMI composite reading was unchanged in February relative to January at 50.2. The average for those 2 months, 50.2, is above that from October to December, where it was 49.3, and that suggested the Eurozone economy was improving in Q1 before today's number. Now, we've got a rise to 50.4 in March here on the back of some improvement in manufacturing for Europe across Germany and France. Michelle, when we were just talking before the show, you noted that services were weaker in Germany due to companies reporting they were unable to pass on price increases as well lately. So that may not actually be bad news, since it may keep the European Central Bank on a path towards more cuts. Now, the data for the U.S. on the PMI this morning, a little softer here. We had U.S. manufacturing drop below that 50 level. That's the threshold between growth and recession in manufacturing, dropped down to 49.8. So really kind of right at that level, but it was expected to be 51.7, same as last month. So, or same as the earlier reading. So that's a little bit of a disappointment there. Nevertheless, U.S. stocks are up this morning on some talk about tariffs. We'll get to that in just a few minutes, but let me cover some of the other issues going on this week beyond Europe. China's stock market is one of the best performing in the world this year, and we got earnings from a big driver of those gains, BYD. That stock has soared nearly 50% this year, and it's gained further today on an earnings beat, even as Tesla has fallen nearly 40% this year. BYD surpassed Tesla as the world's largest electric vehicle maker. The car maker recently unveiled a lineup of electric vehicles that can charge nearly as fast as the time it takes to refuel a regular car, like 5 minutes. So the market's watching these results very closely. BYD looked as the Tesla killer coming out of China. So we'll see how that shapes up. Clearly, the market's responding well to those results again this morning. Now, on Tuesday, we get a key measure of U.S. consumer confidence. The Conference Board's Consumer Confidence Index likely fell in March if sagging sentiment in the University of Michigan's preliminary March survey is a guide. And then on Friday, somewhat related to that, we get the February U.S. personal income and spending report. And that's going to give us fresh insights into consumption and the core PCE price index. Now, that's an inflation measure very closely watched by the Fed. It's preferred by the Fed over CPI. Monthly core PCI inflation likely rose to 0.35% in February for the month. That's double the pace consistent with the Fed's 2% target. So could be some bad news on Tuesday on the inflation front here. Very stubborn inflation in the U.S., even as consumer spending begins to slump. Now, April 2nd may be one of the most important days of the year for investors. Our radars are trained on April 2nd. The U.S. is preparing to announce new and higher tariffs on a wide range of imports across virtually all countries. And so I'm going to go through a little bit of our assessment of what, why, where, and how big for those April tariffs. We got some news, in fact, overnight related to those, helping to lift stocks this morning. So what's happening? So April 2nd is likely the date the scale of President Trump's tariff plans is likely to be unveiled. Yeah, we've seen bits and pieces, but maybe the full scope, at least a good view of the full scope, may be unveiled on April 2nd, even if the implementation is delayed by a little bit. Back on February 13th, President Trump signed a presidential memorandum ordering the deployment of a study due April 1st involving tariffs and non-tariff barriers imposed by other countries to provide guidance on setting specific rates for U.S. imports. And the Trump administration is likely to unveil new tariffs the following day, April 2nd. Also, April 2nd is when the 4-week delay on the tariffs on Mexican and Canadian goods compliant with the USMCA is going to expire. So lots of things coming together. We've got this table here, which is getting longer and longer and longer. Michelle's keeping this up to date with what's going on. So we've got those shaded areas in terms of what's kind of happened so far, but we've got a lot yet to come here. Michelle, what do you think your next update to this table is going to be?
Well, like you said, we're watching April 2nd, and we're thinking about reciprocal tariffs and what that means. We don't really know yet what that means.
Yeah, so let's talk about what that means. So on just yesterday, we got some news reports citing officials close to the matter, so unnamed officials, reporting that President Trump will announce widespread reciprocal tariffs on nations or blocs on April 2nd, meaning economic blocs like the Eurozone, but is set to exclude some countries. We don't know who. And the administration's not planning separate sector-specific tariffs to be unveiled at that same event. But they may still be coming. What we do know more specifically is in mid-March, there was a meeting between Commerce Secretary Lutnick and U.S. Trade Representative Greer and Canadian officials. We had the Ontario Premier and the ambassador to the U.S. from Canada. And that meeting had a readout, and it revealed what the high-level elements of the coming tariffs might include. First, a shift in tariff emphasis from a country-by-country approach to an industry-by-industry approach, specific emphasis on cars, semiconductors, and pharmaceuticals as areas really being targeted by the Trump administration. The details are likely to be complex. Michelle, you've talked about this before, the potential for individual tariff rates on up to 17,000 different product categories across 193 different countries. So very complex to be implemented by our Customs and Border Control. That could be coming here on April 2nd. So the complexity could be something to keep an eye on. Second point, the U.S. calls this tariff rate reciprocity, but the rates don't appear to be connected to import tariffs applied by other countries, making them kind of fluid and hard to predict exactly what they're going to be. And third, countries may be able to negotiate lower rates on targeted industries that I mentioned by aiding U.S. objectives in other ways, like by fentanyl, slowing fentanyl precursor shipments to the U.S. from China, or slowing immigration across the borders from Mexico and Canada. A lot of things have already been targeted by the Trump administration, and that's important in understanding why tariffs are being put in place. Because as an economic or fiscal policy, the tariffs are unlikely to benefit the U.S. There is lots of research, along with the most widely used economics textbooks like Mankew's Principles of Economics, the most widely used one today, or Samuelson's economics textbook that I used in college, all show that higher tariffs tend to restrict productivity and growth while raising prices. Fiscally, tariffs will not cover the cost of extending the 2017 tax cuts, even if you use the most favorable of assumptions. But as a geopolitical tool, tariffs are replacing sanctions as Washington's preferred method of statecraft. And that's why I think they're being used. Achieving lower tariffs to access the U.S. market is likely to require countries support U.S. objectives around the world. Demands may include things I already mentioned: fentanyl, border crossings, defense spending in Europe, purchasing U.S. energy by the UK, narrowing trade balances by Korea, adjusting tax rates in Europe, currency values maybe in Japan. This is all based on what we've heard from President Trump thus far. But countries may prefer to replace lost demand from the U.S., exports to the U.S., by stimulating their own domestic economies and lowering trade barriers among themselves as an alternative to acquiescing to shifting U.S. demands. Choosing to boost domestic demand is in fact already underway in Europe. Specifically, Germany's lawmakers passed a landmark spending package, we talked about this last week, which allows for excluding defense spending from debt restrictions and sets up a 500 billion euro fund to invest in infrastructure. That's massive. That can add a really significant amount to domestic economic growth in Europe and not worrying about what exports to the US look like. China is also increasing domestic stimulus. We discussed that in a recent article called Making International Great Again, if you want to check that out on schwab.com. And there are new bilateral trade agreements that are in the works. In fact, the most recent headlines involve deals with India and the European Union and India and New Zealand. Everybody reaching out to India a little bit there, kind of a rising manufacturing power. So, Michelle, there's a lot going on around the world in terms of countries looking to maybe offset the potential weakness in exports to the U.S.
Yeah, that's right. And as you mentioned, there's fiscal stimulus happening in Europe and in China, and even Canada is talking about some measures to kind of reduce any kind of impact that this could have in kind of the short term.
Yeah, it's interesting. Both candidates, so you've got Carney on the liberal side and Pierre Poilievre on the conservative side, heading into that upcoming election in Canada, both talking about different proposals to stimulate domestic growth within Canada. So yeah, more and more we're seeing this around the world. So it's sort of easier and more confident to, and probably more politically palatable to spend more to grow your domestic economy. Spending tends to be popular domestically, whereas trying to find ways of complying with shifting U.S. proposals or requests or demands is maybe less popular and a little bit more challenging. So interesting. So where are we going to feel these effects on April 2nd? Obviously worldwide, but let's focus on the EU and Europe, on North America and China. Those are going to be the biggest ones to focus on. They're big trading partners. Let's start with the European Union, because we haven't really talked about the EU yet. We've talked a lot about Canada, Mexico, and China, but let's focus on the EU. It's not clear what reciprocal tariffs the U.S. is likely to impose on imports of goods from the EU on April 2nd. The EU has previously offered Trump some concessions. They did offer reducing tariffs on U.S. vehicles. Car tariffs in Europe are 10%. So, that really didn't, really didn't grab the president's attention. They talked about increasing more purchases of U.S. liquefied natural gas. They've offered to take on more of the burden of providing for Europe's defense. That seems to be growing momentum in Europe. Although the EU's weighted average tariff rate is 1.3%. So the EU charges 1.3% basically on imports coming into the EU. So a reciprocal tariff, I don't know what that would look like if you're just focusing on that. But since the Trump administration is focused on Europe's value-added taxes, those are sales taxes. They're applied whether goods are produced domestically or imported. If you look across Europe's largest economies, that sales tax ranges from 19% in Germany, it's 20% in France, it's 22% in Italy. You can see it here across a lot of different countries. That's the dark blue here is the sales tax across these countries. And then added to that is the EU's weighted average import tariff rate here. So if you look across here, you sort of add that on top. The Trump administration seems to be adding sales taxes to actual import tariffs to kind of come up with some kind of combined tariff rate to sort of call as sort of a fair number to compare to what's going on in terms of what they may apply to imports of EU goods. So that's where you could kind of get to maybe a, 20-25% number, I guess, if you added these things together. Now, keep in mind, EU goods exports to the U.S. account for about 3.5% of EU GDP. That's per IMF data. Now, I'd estimate that a 25% tariff on the EU would likely result in a near-term direct hit to the EU economy of about 0.8% of GDP, assuming a pretty high price elasticity of those goods. Now, as an offset to that estimated impact to growth, as we mentioned before, Germany, Europe's largest economy, has approved a big defense spending and public investment package. We're talking about defense spending above 1% of GDP per year, and the infrastructure fund is expected to lead to an increase of fiscal spending of about 1.5% or so per year for the next several years. So you can see how combined this does a lot more than offset a potential drag on GDP growth of less than 1%. And in fact, on March 6th, the European Council voted to advance a proposal, the Rearm Europe plan for 2030, to exempt defense spending from EU fiscal rules. So not just in Germany, but across the EU, and set up a loan facility to fund military expenditures. All this would still need approval by individual countries, but you're seeing more and more stimulus. Finally, we're probably going to get 2 more rate cuts by the European Central Bank this year, taking the policy rate down to 2%. So all that added fiscal and monetary stimulus may deliver a potentially sizable boost to growth, more than offsetting the drag from any potential tariffs that could include, VATs and the weighted average tariffs kind of come to this sort of number of 25% that Trump likes to apply seemingly to every situation he comes across. You can kind of justify that a little bit if you added the sales taxes in Europe. And if in fact he does that, I still think you could see more of economic growth offset from what we're seeing in terms of stimulus domestically. Okay, that's Europe. Let's talk about North America. Or Michelle, let me open this up before I jump into North America. Thoughts on Europe, value-added taxes, exports, domestic growth, the elections. What do you see there?
Yeah, I think, and we've talked about this on the last couple of weeks, but this spending that they're doing in Germany. Remember, Germany has always been the most resistant to fiscal spending. So the fact that they're opening their wallet and that in itself is a big deal. And the second is that the size of the spending that they're looking at is just huge. 500 billion euros just for infrastructure alone. That's 11.5% of last year's GDP. Now, they're not going to spend it all in 1 year, but you drag it out over 10 years. That's, like you said, 1% increase in GDP a year. And so they're really finally doing something with some urgency to address this stagnation that they've been in recent years. So I think it's really a big deal.
Yeah, you've called it a watershed moment. I think thinking back to 2011, 2012 and the European debt crisis, how Mario Draghi talked about, from a monetary policy standpoint, is, head of the European Central Bank, how that was, they're going to do whatever it takes on monetary policy to fix that debt crisis, which of course they did. This is sort of that whatever it takes moment on fiscal policy. They're going to do whatever it takes to offset this, almost existential challenge coming from the Trump administration when it comes to European defense and exports. So really interesting, and that certainly was very definitive in terms of really putting to bed a lot of the issues around peripheral countries and widening spreads and all those kind of issues. So really interesting to see Europe coming together on this. Obviously, there's much more to come. And there's certainly been a lot of political change in Europe as well, but it's interesting to see how they've really come together on this. Okay, North America. So earlier this month, President Trump paused the Canada-Mexico tariffs that had been implemented 2 days earlier for goods with no tariffs under the USMCA. Now, it's possible this is extended on April 2nd, limiting the exemption to USMCA compliant goods covers about 44% of total imports from Canada and Mexico. Another 40% of that total enters tariff-free based on the US's most favored nation tariff schedule or other trade programs. So for companies with products imported not under the USMCA rules, but under the MFN rules that get zero tariffs, claiming eligibility then under USMCA requires some paperwork and requires them showing that 50 to 60% of the value added of a good must be done within the US, Mexico, and Canada. That might be easy for some. It might be challenging for some other industries. And other industries have higher thresholds, like autos. You have to have 75% of the value added to that auto coming from the US, Canada, and Mexico to qualify under the USMCA. So there could be a kind of an air pocket here as a number of those exports and auto makers really have to scramble a little bit to validate how much of that product is being created with the value added is being created within the USMCA nations. Mexico's exports make up about a third of the country's GDP. About 80% of that goes to the US. So the economic hit to Mexico of 25% tariffs on more than half of all exports to the US would risk a recession. But the impact on Mexican companies may be much less. Heather put this chart together. I think it's great. Mexico's largest exports to the US are goods produced by US companies operating in Mexico, not Mexican companies. I've said that many times on this show this year, but I want to drive it home again. Mexico's biggest exporters are automotive manufacturers headquartered in the US and listed on US stock exchanges. That's Ford and GM, among others. In contrast, a lot of Mexican companies that have large US sales come from their operations in the US. They don't cross a border, so they're not subject to tariffs. Cemex is a great example. It's a big Mexican cement maker. They don't make Mexican cement. They don't make cement in Mexico and ship it to the US. They make it in the US. In fact, 4 of the top 5 Mexican stocks that make up more than 50% of the US, the MSCI Mexico index, you can see it on this chart here, are not likely to be impacted by the tariffs because they don't have any US sales. Only one of those companies, Grupo Mexico, which is a mining company, has some US sales that may be subject to tariffs. But the others, you've got in here a bank, a telecom provider, Mexico's Coca-Cola distributor, and Mexico's Walmart. None of those have exports to the US, so they're just not impacted. And that's similar for non-energy Canadian companies as well, making for what would likely be a bigger economic impact and potential recession for Canada than an earnings or market impact for Canadian or Mexican companies. Now, outside of energy, which may be impacted by a lower 10% tariff, according to the Trump administration, Canada's exports, the U.S. has a goods trade surplus with Canada. That's right. We actually sell more to Canada than Canada sells to us, according to data from the U.S. Census Bureau. It's really only energy that causes that balance to tip, and of course, that's subject to lower tariffs. So really interesting to see how this is shaping up, and maybe one of the reasons that the delay on those tariffs may get extended on April 2nd. I think the market's betting on that right now. Of course, we don't know, and we'll have to see. Now, for China, and Michelle, I want to bring you in here on China, but for China, it appears that there's little the government can do to appease the Trump administration or reduce its trade surplus with the U.S. Trump's new 20% tariff implemented in February, right? It was 10 and another 10, brings the total level of tariffs on China to 45% for most goods. China's retaliated with its own various measures, tariffs, export controls, restrictions targeting U.S. companies. Additionally, China continues to announce new stimulus programs intended to support domestic consumer demand, which makes up nearly 40% of China's GDP. Michelle, how is that ramping up so far? You can take a look at the chart here. You can see China's GDP broken down, consumer spending way bigger than net exports, and only a portion of those net exports go to the U.S. So can they do this? Is this working?
Well, not yet. They are spending more. Their fiscal deficit is going to increase this year compared to last year. So they are spending more. And, there's a little bit of an improvement, I would say, in business sentiment at the moment. And that could be good. If businesses' view about the future improves, they might start investing and hiring again. But consumers themselves are still quite, the confidence there is low. And so, so far, they keep saying that they're going to give us some kind of a consumer stimulus, but we haven't seen a lot yet. But it's certainly on the top of their mind.
Yeah, so China also looking to see how much stimulus they need to apply to offset any potential impact of these Trump tariffs. So again, sort of the Trump administration kind of making many of these countries kind of reconsider their domestic policies and really step it up a little bit. Now, how big of an impact might these new tariffs have on the overall world economy? We talked about Europe, we talked about North America, we talked about China. Certain industries might be heavily impacted, right? We talked about drugs and chips and cars. The overall global impact, though, may only be a mild negative depending on the scale and scope of these new tariffs. The current weighted average U.S. import tariffs in place amounts to about a 10% across the board tariffs. Based on 2024 import volumes calculated with the additional 20% on China, 25% on non-USMCA compliant imports from Canada and Mexico, 10% on energy exports from Canada, and 25% on steel and aluminum, we're looking at kind of a 10% increase here, or 10% across the board tariff. Now, back in October, the IMF published an analysis of how a 10% across the board import tariff implemented by all countries would impact global growth. And their conclusion was a 0.4% hit to U.S. growth, but only a 0.1% drag on the baseline forecast of global GDP growth of 3.2% in 2025. Now, so far, new tariffs have largely been a U.S. issue. have seen retaliatory tariffs on the U.S., but we haven't seen those matched by other countries, meaning that Europe hasn't put huge tariffs on China, China hasn't put huge tariffs on Europe, and et cetera. It's really just been a reciprocal U.S. phenomenon. So the impact might even be less than what the IMF forecasts. So we'll have to see. I think we've already seen maybe a lot of the impact of higher tariffs already implemented on the world. Remember, China is a huge U.S. trading partner, so is Mexico and Canada. The EU is a much smaller trading partner to the U.S. So if we were to apply new tariffs there, it might not have that much of an incremental impact on global growth. So what we're seeing here is maybe not that dramatic of an impact. I note the latest update from the OECD really shows consistent growth in global GDP. Yes, the U.S. slowing down this year, but a lot of the other economies picking up. That was just updated last Monday. So still looking at solid growth for this world's global economy and global earnings growth as well. So again, rising rising European earnings forecast going along with that, even as U.S. earnings growth has been revised down a little bit here, and widening outperformance by international stocks, which tend to be very economically sensitive, especially in Europe. I'll just highlight this chart. Again, it's one of my favorite charts. I know I brought it up on this show over the last few years. What we're seeing here is strong outperformance by international markets going back to the beginning of this bull market. The EFI index of developed international stocks is outperforming the S&P 500 since when this bull market began back in the middle of October of 2022. Here we can see, I'm just focusing on Europe here. We know Europe's to be targeted next, and Europe's going through a difficult time with the manufacturing recession. And in the fourth quarter, you see the dip here in that blue line. That's Europe's EMU, European Monetary Union Index of stocks compared to the S&P 500. Really took a hit in the fourth quarter on the Trump election, but has rallied back powerfully and is now once again a very wide margin of outperformance above the S&P 500. We've been talking about this for almost 3 years now, that international is outperforming the U.S. A lot of people, hard to look beyond the NVIDIAs of the world, but out there, we continue to see this consistent outperformance by international markets. And that's why I think this show is so important to shine a light on that. And I continue to shine a light on that and continue to recommend considering diversification globally in your portfolios. People often ask me, Jeff, how much international should I have in my portfolio? And my answer is pretty consistent, probably more than you have now, because for so long, U.S. outperformed, but over the last few years, we're seeing this shift take place. And generally, when we get to the 3-year mark, when we see international outperform the U.S., that's where we really start to see a lot of flows begin to kick in, people recognizing and beginning to catch up in their portfolio. So you can still get ahead of that. It's not too late. I think we're in a cycle of outperformance by international. Yes, it's been strong and consistent, but I think there's more to come. All right, Heather, let's move on to chat Q&A here. And I know we've only got a few minutes left. I had a lot to cover there, but let's hear what's on the mind of the chat.
Okay, yeah, we do have a couple of questions. Now, we did see a pretty significant market correction in the U.S., and you did mention that global growth is not likely to be impacted much, but what actually is the risk of recession, either U.S. or on the globe?
So looking at the forecast for U.S. recession, in the first quarter here, there's even a chance that U.S. GDP is negative. Now, globally, we sort of talk about 2 quarters of back-to-back negative GDP growth as the definition of a recession. The U.S. has its own definition of recession based on some of the numbers that come out of the National Bureau of Economic Research and the 5 indicators that they track. They're not really pointing to recession right now, just a slowdown. Let's say a slowdown from, to maybe 2% growth or 1.7% growth here in the U.S. this year, and maybe a little bit weaker in the first half of the year on all this related uncertainty. The odds have gone up of recession. They're not close to 50% yet. I think, speaking recently last week with our U.S. strategist, Liz Ann Saunders, our fixed income strategist, Kathy Jones, the odds are rising, certainly, but not yet at the 50% threshold. We'll have to see what is unveiled on April 2nd as it relates to that. Uncertainty can cause businesses to slow hiring, to not invest in growing manufacturing or equipment, to consumers to pull back a little bit. And so we're seeing some of these concerns begin to shape up here in the early data. And indeed, today's data on the PMI, an indicator I think is an impeccable track record of predicting economic trends continuing to slow in the US. So some worrisome trends, but we're not quite at that over 50% threshold for a recession yet in the US.
Yeah, I'm just going to add to that. There is two different impacts on growth. One is the actual tariffs, and the second is uncertainty about the tariffs. And what we've really seen is a lot of the uncertainty. I think once we have some kind of certainty, then businesses they know what the rules of the game are, then they can plan. And, right now, though, it's just really difficult. That's why markets, indigest.
For sure. And you pointed out before, Michelle, how, in fact, the IMF, when they did their analysis of what is the impact of tariffs on global economic growth, it was actually the uncertainty around them was a bigger negative than the reality of them. So really interesting to see. And that's why I think the delay of tariffs is almost worse than implementing them or not implementing. At least if you put them in place, people know what the rules are, can adapt. Not knowing, delaying, shifting them constantly, having leaks come out and then reversing those leaks. It just creates an environment where I think businesses are a little bit paralyzed and create a little air pocket for growth. And that's so far what we're seeing here in the first quarter. I think I didn't see what the latest Atlanta Fed GDP now number is. So that's where they assess every data point that's coming in as it's coming in for first quarter GDP. And here we are on the 24th. But I think last time I saw it was pointing to a negative number for first quarter. Obviously, there's some data that gets reported in April for March, so those numbers could bounce back a little bit, but looking pretty soft here in Q1. So odds of recession have risen, but maybe not crossing that 50% threshold just yet.
That Atlanta GDP also, they're making some revisions for imports of non-monetary gold. It had a big negative impact on the quarter for some reason.
Yeah, gold being an attractive asset here in the first quarter. All right, Heather, what else do we have?
Well, we are pretty close to time, but sort of to wrap up one other thing. We mentioned about countries working towards U.S. objectives to kind of help mitigate some of the tariff risk. Given that we have global supply chains, are there actual companies or industries themselves able to lobby effectively to help reduce some of the tariff impacts on their own industries?
I don't know. I mean, they're certainly attempting to do so. There's a lot of U.S. businesses that are, clearly back channeling into the administration saying, please don't do this. The unintended consequences are huge. Most recently on shipping. So, there's talk about putting fees on ships bringing goods to the U.S. if those ships were made in China. And of course, the massive portion of the world's global shipping fleet are Chinese ships. And so, we make almost no ships in the US. And so to return to major shipbuilding of the size of vessels we're talking about could take a decade or two. And in the meantime, there'd be a very substantial increase of fees on shipping things to the U.S., which would just get passed on to customers and could be very inflationary. So I think there's a big pushback there saying, well, hold on. Get the idea that, maybe we need to do some shipbuilding, maybe not, but we could really see some major dislocations of supply chains were that to be implemented without some thought going into it and maybe even a phased in transition over many years as opposed to being abrupt. So a lot of that pushback is going on. I mean, there's some of this thought in the administration that, hey, you throw stuff out there and if something breaks, then you fix it and you kind of learn from that as opposed to being too timid and not putting a lot of these very, very radical changes into place. So we'll see what happens. I think it's sort of, 2 steps forward and then 2 steps back in some cases. We've certainly seen that so far with many policies this year. So it is keeping things up in the air. Global supply chains are vulnerable to a lot of these things. We'll continue to keep an eye on the major ports and all the traffic around the world to see if they're actually having any physical effect. And of course, we can watch actual booking rates as they come in on a daily basis as well to see if there's any effect there. So we are seeing a little bit of a slowdown, but nothing too dramatic just yet. But again, we'll keep you informed. So thanks for those questions. Sorry we didn't get to more than this week. We'll look forward to doing that next week. Lots to cover. But I want to thank Heather and Michelle, and of course our producers, Andrew and Gabe, and everybody for those questions and for joining us. You can tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets. And of course, we'll see you again next week.